What's going on today, YouTube? Today, I want to tell you guys the easiest way to guard against inflation with a diversified portfolio. Alright, real quick. Now, this is a figure out of the book The Intelligent Investor by Benjamin Graham. And whole point of this graph, you want to cover yourself from inflation. Quick little quote from Henny Youngman. 20 years ago, 20 years ago, it took two people to carry $10 worth of groceries. And today, a 5-year-old can do it. And his whole point here is because of inflation. So, most people think inflation can only mean one thing for the stock market. This little graph here, bar chart, I want to show you guys. Look, when inflation was at its worst, they call this deflation, negative 10%. This is from one year to another. Now, this little bar chart, it's from 1926 to 2002. And this is not in chronological order. This is just showing from the worst inflation, they call deflation, to the best years of inflation. But anyways, so the inflation, it dropped negative 10% from the previous year to this year. And I want to show you, look at the biggest drops, biggest deflation in this almost 80 year span. Stock market, terrible returns. Now, look at the opposite. So you're thinking, okay, deflation, that means stock market has terrible returns. You think the opposite, so the more inflation goes up, the better the stock returns are going to be. And you look over here. That is not the case at all. When you have your major deflation and major inflation, that's when the stock market is, for the majority, performing the worst. Now, yes, you do have these cases in here where you have average deflation or average inflation from year to year, and the stock market does fall. But look at your majority of your losses. It's when the inflation is completely out of whack. And when the inflation is normal, slowly falling or slowly rising, that's when the majority stock returns are being good. So, that is just to prove to you guys from this little study that it's not the case. Like, you can't judge what the stock market's going to do just solely based off of inflation. Now, basically what I'm trying to tell you guys, you can't put all your eggs in one basket. To be truly diversified, have a diversified portfolio, how to protect yourself. Like, the whole point of having a diversified portfolio is to protect yourself in the best cases and the worst cases. So when the stock market drops, you're not going to have this major loss because you have stuff that's going to go up when the stock market drops. That should make sense. I hope that should make sense to you guys. There are things that go up when the stock market drops. But anyways, so back to the topic. Guarding against inflation. There are two things that can protect you against inflation. These are REITs and TIPS. REITs are real estate investment trusts. Now, all these are basically real estate that's collected from commercial properties and residential properties. So, in my eyes, the whole reason why this works to protect against inflation is because when inflation goes up, that means the price of homes are going up, everything's going up, your rent. So they're always going to go up with inflation, whereas sometimes, as you saw from that chart, stuff goes down when inflation goes up. But the cost of everything, inflation's going up, so the real estate man's going to say, hey, we had inflation this year, I'm going to have to raise your rent price, raise whatever price you pay. So that's the psychology behind it. Why these go up with inflation. So these are not funds that are going to gain you guys money. These are funds that are just there to protect and in a sense and minimize your losses. That's what it's for. Now, for REITs that you could get into that are very highly recommended, not by me. This is I did my research. It's a Vanguard REIT index, the Cohen and Steers Realty shares, Columbia Real Estate Equity Fund, and finally the Fidelity real estate investment fund. Now, the other one are TIPS, Treasury Inflation Protected Securities. These are, in a sense, they're from the government, and if inflation goes up, the values of these are going up. The only catch with these, it's kind of weird, but the whole catch with these, they're very, very volatile, so you don't want to be like actively trading them. You want to, they say at the most, of your retirement fund, you want 10% allocated to REITs or TIPS. No more than 10%. And the whole reason behind this, they're very volatile, so you don't want to try to like time them, get in and out. You just want to keep them in, put it in. And they're permanent, just think of it as permanent lifelong holding. The one weird part about them though, when they go up, you have to pay taxes on it. It's not like the normal stuff where you only pay taxes when you take it out. You have to pay taxes as it goes up because hey, inflation went up, so Uncle Sammy wants part of his money because he gets everything you guys get. Yeah, so those two are the best. Good place to put these. Put these in your IRAs or in your 401ks, like your tax deferred retirement plans. Have 10% of your portfolio regarding this. They don't recommend anymore because these are not made to make you money like stocks are or bonds are. These are just made to help you through inflation periods or deflation periods. Now, real quick, one other thing. Why, I'm sure some of you guys are thinking, why do I even care about inflation? What's it really matter to me? Well, I'm gonna give you guys a fun little tip. Back in like 1980s, CDs. I'm sure you guys heard of CDs. CDs are just a little thing that you can get from banks, and they're supposed to go up and give you it's like a fixed rate over so many years. They were promoting CDs to give you an 11% return back in the 1980s. Funny thing is, yeah, this sounded great to everyone. This is when inflation was going nuts. This is when we had the highest inflation periods. I think from 1979, somewhere 1979 to 1980, just in 1 year, it was almost a 20% increase in inflation. So yeah, these CDs sounded great, but guess what? They were still losing out on money because inflation was over and beyond what they were getting in return for their CDs. So people don't think about that. They don't think, oh, inflation really doesn't matter because the price of everything's going up. But if you're investing in your portfolio, it really does matter because your returns, say you make 8% that year on your entire portfolio, and inflation went up 6%. Guess what? You really only gained 2% that year. So, yeah, now, well, to add on to that fun little fact, in 2003, CDs were only at a rate of 2%. So, that 2% doesn't sound great, but it's honestly the same exact thing as it was back in 1980. They're giving you 11%, but inflation was crazy. They give you 2% now, and inflation, it's right around there. It's right around like 1.5 to like 2 point something. So you would have been making the same amount on your CD back then as you were now, even though you were getting 11% return versus a 2% return. So guys, that was the main point of the video. I just wanted to get you guys, tell you a little about inflation, how it affects you, why you should worry about it, and how you can protect yourself. So, don't make this majority of your portfolio, but you gotta have it in there a little bit. So yeah, like, comment, subscribe, and I hope you guys have a great week. Keep on going.